Recently, I found myself consuming a bunch of content centered around stocks that others would be happy to invest in now and hold on to forever. As I watched these videos, I started to think more and more about what I would consider to be a buy and hold forever investment. This contemplation led me to two important questions that needed working out. What model would I use to determine which equities fit the profile? And what degree of certainty can I have that these companies would last forever? My name is Paul, and in this video, I'll be breaking down the deductive process that I used to come up with satisfactory answers to these questions. The process involved looking at current and historical examples from different securities and industries, as well as my own conclusions and criticisms of the topic. So be forewarned that this is not a standard stocks to buy and hold forever video. With that said, let's get started. When looking for companies to buy and hold forever, it's important to have a long-term outlook on the industry that the company operates in. After all, forever is a very long time. So, if you can foresee changes that have a reasonable chance of disrupting the company's business model in the next 10 or 20 years, then there's no telling how that company will be performing in, say, 30 or 40 years. Of course, I don't have a crystal ball that tells me how technological advancements and innovation will change the world, but it's still important to look into growing trends and technologies that have the potential to seriously change things. For this reason, I would consider most Canadian bank stocks, which tend to appear on a lot of buy and hold forever lists, to be completely out of the question. Commission-free brokerages, competitive digital lenders, cryptocurrency adoption, and large conglomerates with strong brand power creating their own banking niches by tapping into synergies exclusive to their specific economic moats are all factors that concern the industry, and have a strong likelihood of impacting business. That's not to say that the Canadian banks can't be good investments. The majority of the large Canadian banks are growing, and it could turn out that they end up adopting and even benefiting from some or even all of these technologies. But I can't say for sure that 20 to 30 years down the line, these big banks will be able to continue making good returns on invested capital, let alone compete with the disruptors. Taking a step back historically, it's easy to point out prominent industries that have become antiquated within the period of a decade or less. For instance, in the 1990s and early 2000s, the print newspaper business was at its peak, achieving well over $50 billion per year in advertising revenue. Unfortunately for shareholders in these businesses, by 2011, inflation-adjusted newspaper revenues were cut to 2/5 of what the papers were generating just 5 years earlier. Now, the Great Recession did help to speed up this decline, but unlike most other businesses, the newspapers didn't recover over the following decade. In fact, as of 2020, newspaper industry revenues have continued plummeting, down to under $10 billion. By the way, this figure includes online publications revenues, which have been offsetting the declines in print revenues. Despite the growth in online revenues, the drop in total revenues represents an additional 50% slash from the 2011 numbers, and has led to predictably bad returns even on a nominal basis for investors in the booming paper industry during the late 90s and early 2000s. In hindsight, if investors were fully aware of how the papers were making their money and how new technology was threatening to undermine the business model, then the collapse of the industry could have been predicted, or at least considered as a real possibility, which would have saved many investors a lot of pain. That's because, in this case, the revenue decimation was caused by competing technological innovation. From 2005 to 2011, the percentage of adults using the internet in the United States grew from 68% to 83%, and advertising on the internet at this time was dirt cheap when compared with the standard methods of advertising. Aside from the growing demographics and cheap online ad rates, advertisers had one multifaceted benefit that made print media virtually obsolete. And over the past few years, this innovation has been at the center of many controversies and heated debates. See, the time period during the 2000s to early 2010s marked the dawn of harnessing user data in order to achieve much better returns than was previously possible. Now, the user data that was being utilized at this time was much more crude and less effective than what's being done today, but it was still immensely superior to its predecessor in print media. Where an advertiser was once paying to put their ad in every single newspaper with no way of telling how many people ever opened the page to where their ad was placed, internet advertising allowed companies to pay per click, telling them exactly how many people were seeing their ad. Equally important was that advertisers could purchase ads on specific websites that directly align with their target customer demographics. This significantly expanded the entryway for more niche businesses to start advertising, while also closing the door on the majority of newspapers. For instance, imagine it's 2006 and you own a company that sells fish finders for boats, and you want to advertise your product. Would you prefer to spend more money investing your advertisement dollars in local papers of areas that have an above average population of boaters, or would you prefer to pay less and post your ads on a forum specifically catered to people who like fishing and boating? The answer is obviously going to be the cheaper option that hits your target demographic head on. And the internet provided this for so many different categories at such low prices that even advertisers whose products and services appealed to larger general audiences shifted a large portion of their advertising budget online. That said, it's important to come away from this knowing that not all technological shifts will negatively impact pre-existing business models. In fact, there have been tons of advancements that appear as though they're destined to shake up the entire business landscape, yet turn out to be impractical, ineffective, or are simply adopted. But if you can see the potential for big changes on the horizon of the industry that you're looking at, and you're looking for businesses that you'll feel comfortable holding forever, then that's probably a good indication that you should start looking elsewhere. Noting that, if you're looking to buy and hold companies forever, you also probably shouldn't invest in the disruptive technology companies, even if you're certain that that technology will be disruptive. This is because, even if you know that the technology will be impactful, there's almost no way to be certain which companies will succeed in the usage of this technology. In 2021, at the Berkshire Hathaway annual meeting, Warren Buffett shared some historical insight into the early automobile industry, which was correctly seen as a revolutionary investment that would change the way that people travel forever. Also shown in Buffett's presentation was a list of the former American car manufacturers that went defunct while producing a truly revolutionary product. The list was so enormously large that it took a whole page to catalog the failed contenders whose businesses started with the letters MA. The moral here being that it's easy to be right about the trend, but not so easy to pick the long-term winners. A similar notion was also highlighted in Mark Mahaney's book, Nothing But Net, wherein he explains how throughout the early to mid-2000s, eBay, the largest e-commerce company at the time, was lauded as the inevitable king of the industry due to its high profit margins and non-existent inventory expenses. Yet, if we skip forward 10 to 15 years, eBay stock has only a little more than doubled, which is 50% below the market's gains over the same period of time, and exponentially below the growth of the e-commerce industry. Meanwhile, Amazon, which was much smaller than eBay at the time, was written off by most industry investors as being a weaker competitor that was destined to fail. Jumping forward to today, Amazon now dwarfs eBay, and over the same time period, its stock grew in price by more than 50 times. Hopefully this reinforces the argument that even though innovation may be inevitable, the company that you back isn't. And another important takeaway here is that if professionals whose careers center around studying and understanding these new businesses and technologies are predicting outcomes incorrectly, then you're probably not going to do much better investing in innovation if you're a part-time investor who's considering far less variables. So, if you're looking for a business that you can be certain will be around forever, you need to stay within your circle of competence by focusing on businesses that you understand inside and out, including the business risks and competition. Unfortunately, the principle of understanding a business and its risks is deceptively hard to understand itself. What's worse is that it's easy to convince yourself that you fully understand a business when you actually are only aware of a few key aspects. I may be projecting some of my own misgivings on this point, but I think that my former experience as an investor in the telecom sector will resonate with many of you. Back in early 2016, I started to take note of how ingrained internet and cellular networks were becoming in the majority of Canadians' daily lives. This idea was further bolstered later on in the year when the Canadian government declared that access to the online world is a basic human right. Back then, naive me understood that the future was wireless, and watching cell phones turn into smartphones, which then turned into just phones as even slower adopters, my parents included, decided to ditch their landlines. My confidence continued to grow as data plans became more commonplace and affordable, And I became certain that cellular data would continue to improve to the point where it would replace internet plans, because everyone would have data with their phones, which could be used to create Wi-Fi hotspots for other devices. My research also told me that cellular networks had a long runway of future growth, and the high startup costs paired with the territorial and price matching nature of the competition led me to conclude that the sector was an oligopoly. So, despite the moderate levels of debt held on the balance sheet, I found a company that I felt relatively comfortable parking my excess capital in, and I happily collected my dividends for a few years. So, where did things go wrong? Luckily, returns-wise, they didn't, and the company that I chose yielded decent, slightly below market level returns over the 4-year period, which is quite good for a very conservative investment. The problem was that this wasn't a very conservative investment because I didn't understand the industry, which exposed me to severe disruptive risks, and if left unchecked, this safe yield could have turned very ugly very fast. See, at the time, I was unable to answer one simple, yet highly important question about the business's operations. That question being, how do mobile networks transmit data? For me, not knowing the answer to something so important was unacceptable. So, looking up the answer to this question was like finding the secret passageway behind the bookshelf, and it revealed to me that what I thought I knew about the industry was completely eclipsed by what I had yet to learn. Currently, mobile phone networks operate on 5th generation, or 5G, technology. The 5G network uses towers to transmit data to phones using millimeter shortwave frequencies. These 5G signals operate at much higher frequencies than the previously used 4G signals, allowing more data to be packed into waves that are shorter and tighter together. What this means is that data can be transferred much quicker using 5G than was previously possible on the 4G network. Unfortunately, 5G technology isn't perfect. Because waves are traveling in a much more compact line from the tower to your device, you will have significantly reduced speeds and even lose connection if you aren't within a much closer proximity to a tower than was previously required on the 4G networks. Also, these densely packed 5G frequencies are much more easily blocked by solid objects, like walls and trees, so devices will often automatically switch to the slower but more stable and reliable 4G network in order to correct for the interference or proximity issues. Looking forward, these problems are only set to be exacerbated with 6G technology, and this is because the way that the data transmission speeds are improved involves using even higher frequencies, making shorter sub-millimeter waves that will require less physical obstruction than with 5G, and an even closer proximity to the towers. So, instead of needing one 5G tower on every block or so, there may need to be multiple 6G transmitters within a single home. On the other hand, the future of broadband internet travels through fiber optic cables, which provides much better and more reliable connectivity and speed in most real-world scenarios. On top of that, some cities have been working towards building out large-scale municipal broadband Wi-Fi networks, which could pose a threat to the pricing of cellular data if they can find a way to successfully finance and complete these projects. Now, if a workaround is found to the technological obstacles facing 6G, like say antenna technology that allows individual devices to both receive and transmit signals, then it is possible that both higher speed and connection quality can be achieved. However, given that this technology doesn't currently exist, I didn't feel comfortable knowing that my long-term investment relied on innovative technological advancement in order for things to work out in my favor. Still, there are several companies that offer both mobile and internet services. But even if we ignore the fact that most of these businesses also dabble in declining subsectors, like radio broadcasting and landline networks, I would imagine that there are other quality long-term investments that don't run the same risk of major operations becoming obsolete within the next few decades. That said, taking a look at telecommunications is definitely a step in the right direction, because they provide a service that people need. This is a desirable trait to have, because a needs-based expense is much less likely to be cut from a consumer's budget than a discretionary expense during times of hardship. If there are extended recessionary periods, which eventually there will be, then companies that deal in discretionary products or services are much more likely to fail during these times from a lack of consumer spending. Following this logic, I decided it would be best to look for companies that provide products or services that most people would consider to be a necessity, keeping in mind that I'm still eliminating companies that I believe may be subject to innovation. A business model that I believe achieves this criteria is freight railway transportation. Society is heavily reliant on railroads, as they are by far the most economical way of transporting bulk goods across land, especially between major cities. Also, railroads are fairly impervious to disruption, as there aren't really any efficient alternatives to transporting bulk product across land. Of course, the argument of innovative electrified truck fleets does come up from time to time, but I've yet to see a strong argument for why freight trains wouldn't benefit equally from utilizing electric power. Anyway, much like the telecom businesses, railways require extremely high levels of startup capital due to the costs associated with purchasing the materials, equipment, and labor required to build tracks and stations, not to mention the ownership or rights to use long stretches of uninterrupted land. It's because of these challenges that it shouldn't come as much of a surprise that the two largest of Canada's three Class 1 railway systems were created with direct ties to the Crown. Since then, however, both have been privatized and are publicly traded on the Toronto Stock Exchange. The larger of the two is the Canadian National Railway, and the smaller is Canadian Pacific. And naturally, these are the two companies that I'd be looking at if I were interested in investing in a Canadian railroad. Unfortunately, this is also an industry where I wouldn't feel comfortable investing money in for an extended period of time. See, like the telecommunications industry, I used to be an investor in one of the two major railway companies, though for a much longer stretch of time. In fact, my position in the company dated back to before the Great Recession, when I was just starting to learn the ropes of investing under the guide of my parents. That company was the Canadian National Railway, and in early 2022, I decided to completely dump my stake in the business. The thing that changed my mind about the Canadian freight rail subsector, which I'd originally planned to continue holding for some years to come, was one of the most dastardly and vile situations that I've ever had the displeasure of witnessing play out, at least in a company that I personally owned. To make matters worse, the Canadian National Railway was the largest position in my portfolio at the time. The thing that led me to completely sell out of my position was the incredibly brutal nature of the competition between the two railroad companies, which escalated into a corrupt and borderline fraudulent attempt at supplanting Canadian National's CEO. I'll try to keep the summary as brief as possible here, but before continuing, it is important that you're aware that a lot of what will be discussed in this example is my understanding and interpretation of events based on the research that I've done, and that any interpretation of what happened, including my own, will inherently have some bias, even though I will be doing my best to explain things as accurately as I'm capable. Still, there is a lot of detailed information that I will be leaving out for the purpose of brevity, so I would recommend that you go and do your own research in order to better understand the following events. With that said, in March of 2021, Canadian Pacific offered to buy out a different railway company called Kansas City Southern, and in April of 2021, Canadian National Railway made a larger bid for the exact same company. Kansas City Southern was a very attractive acquisition for both railway companies because of its special regulatory deal with Mexico, which made Kansas City Southern the only railway company allowed to cross the US-Mexico border. So, the Canadian railway company that won the bidding war would end up being the only railway with a constant track running from Canada through the United States and into Mexico. This meant that whoever acquired Kansas City Southern would be able to significantly lower the cost of transporting goods that would have previously had to switch from one railway company to another at the Mexican border. This would also likely lead to lower pricing on international freight transportation for the winner, thus making the margins somewhat worse for the loser if they want to stay competitive. And this cheaper and more convenient route would likely contribute to some customers switching railways regardless. So, the stakes were high, and as you could probably expect, Kansas City Southern agreed to Canadian National's higher offering. But because of how the deal was structured, regulators ruled that the deal did not meet the standards of current merger regulations. Up to this point, everything had been above board, and Canadian National was tasked with reworking the deal to meet regulatory standards. It was at this time that an activist hedge fund started buying up tens of millions of Canadian National shares, all the while claiming that Canadian National Rail should give up on trying to acquire Kansas City Southern, calling the deal an egregious failure and oversight that would cost Canadian National upwards of $2 billion in fees. On top of this, the fund called for the immediate resignation of acting CEO J.J. Roost, alongside 4 of the 10 independent directors, all of which had planned successors that appeared to be selected by the hedge fund. Now, the situation as explained up to this point hasn't exactly been ideal, but this sort of thing does happen, and I do think that investors should have the right to advocate for changes in the businesses that they own shares of, as long as these changes coincide with what is believed to be in the best interest of the shareholders. The dilemma here was that this particular activist fund had a clear conflict of interest, due to it being the largest shareholder of Canadian Pacific Rail, who was competing against Canadian National Rail to acquire Kansas City Southern. The public outcry from the hedge fund was dubbed by the actual Canadian National Board of Directors in a letter to shareholders as being conflicted and dangerous, insinuating that the fund used misinformation to propel their campaign against Canadian National's bid, highlighting the fact that Canadian National stood to gain $700 million from Kansas City Southern in the event that the deal fell through, as opposed to losing upwards of $2 billion as claimed by the hedge fund. Within 3 weeks of the fund's attempt to sway shareholders' opinions on Canadian National's merger ambitions, Canadian Pacific increased their offer to a value still lower than the Canadian National Railways. In light of Canadian National's regulatory rejection and activist hedge fund issue, Canadian Pacific's offer was accepted by Kansas City Southern. About 1 month later, in mid-October, Canadian National Railway's CEO put in his notice of resignation. Then, 2 more months would pass when on December 14th, Canadian Pacific Railway announced that they completed their acquisition of Kansas City Southern. Within 1 week of the deal closing, the hedge fund-backed CEO candidate withdrew his candidacy to take over as the leader of Canadian National Railway, notifying the board of directors that he was no longer interested. Personally, after taking the time to process these events, I realized that I was no longer comfortable knowing that a large portion of my capital was being held in a company that was nearly hijacked and ravaged over an acquisition that admittedly would have been beneficial, but not so much so that it would have left even a moderately negative impact on the loser's pre-existing business. Now, the option to invest in Canadian Pacific Railway was still on the table, but the idea of putting my money into a company whose top shareholder uses underhanded and borderline fraudulent techniques to secure business prospects isn't exactly something that I want in on for moral reasons. Though I wouldn't say that I'm entirely convinced that these sorts of tactics will provide a good return on capital if continued over the long haul. So, as much as I like the idea of railways in terms of a quality long-term business, the excessive lengths to which the competition are willing to go really tempered my opinion of the sector, at least in Canada. I am still thankful that I did get to take a lesson from this situation, and that strong competition can create harmful effects, even in needs-based sectors with few competitors. So, I again reframed my search criteria to only include businesses that are, by a significant margin, the main provider of a product or service. This requirement will seriously limit the number of possibilities available, since companies that operate as borderline monopolies aren't going to be very common, especially when looking in equity markets. This is because in Canada, like most other first world countries, there's legislature in place to prevent anti-competitive business practices. Because of this, most businesses that don't have any major competitors are either owned and operated by the government or operate with pricing regulations. When using this additional requirement to filter for companies, the first industry that came to my mind was utilities. More specifically, companies that own or have indefinite exclusive access to infrastructure that effectively excludes all competition, at least geographically. For example, a company that owns and operates a water treatment facility isn't likely to have any competition for the consumers of their service. This is because that company would be responsible for treating all of the water or wastewater within their geographic jurisdiction, which would mean that the company would own or have sole access to the sewer system within that district. This would effectively box out competitors because maintaining a treatment facility and a network of sewer lines is incredibly capital intensive. On top of it being costly to build out a new competing sewer system, there would also be no guarantee that customers would switch providers, even if the service's costs were lower than its competitors. After all, most people probably wouldn't want to undergo the inconvenience of dealing with a digging crew tearing up their yard in order to save a couple of bucks per month. And in the instance where the sewer is owned by the government or a different private party, the idea of multiple companies competing for the same set of customers in a needs-based, price-regulated, capital-intensive business usually leads to very bad outcomes for the consumers. See, if there are two facilities competing for the same group of consumers, then both companies are going to have higher relative operational costs due to their lower levels of scale. To highlight this issue in effect, let's compare the maintenance costs of the two competing smaller facilities versus the monopolistic larger facility. The two competing facilities would each be subject to pipeline and facility depreciation and degradation at roughly the same rate as the larger facility. But because the two competing facilities are fighting over the same number of customers as the large facility, there's less money coming in to the competing facilities to pay for repairs. So, in order to make a profit, or at least break even, the two competing companies would need to raise their prices, which would be a minor annoyance for many, while disproportionately making it harder for poor people to afford water services, creating a scenario where everyone loses. And that's probably the best of all possible outcomes involving competition in the sector, since cutting costs by not repairing the infrastructure could easily turn into a serious health crisis, and losing money until an inevitable bankruptcy would require government intervention, and would probably cost even more money. Because no one wants any of those bad outcomes, there generally aren't any options for consumers to switch water service providers. Noting that, there's only one water utility company that's publicly traded on the Canadian market that matches the description of what I'm looking for, at least that doesn't dabble in other operations. Unfortunately, this is a company with a very small market cap, and I do not discuss specific companies with small market capitalizations on my channel. But I believe that this company in particular is trading at sky-high valuations regardless of which metric you look at. I believe that because of the high level of safety being offered on invested capital, you should expect to pay a premium on true buy and hold forever stocks. But that doesn't mean that paying any price whatsoever can be justified. In this case, paying an earnings multiple of over 60 for a company that has minimal growth opportunities is not going to be a sensible option. Thankfully, there is another utility subsector that operates in a business landscape that has a similarly minuscule level of competition, that being the electric utility subsector. And more specifically, I want to focus my attention on companies that are more heavily weighted towards the transmission and distribution aspect of the sector, rather than companies that bring in a large portion of their earnings from the generation of electricity. The reason for this has to do almost entirely with the potential for regulatory changes on the different ways of generating electricity. See, many companies own several different types of power plants that harness energy from sources like natural gas, nuclear energy, and solar panels, and all of these methods are open to the potential to be impacted either positively or negatively by regulation. It's no secret that many people are concerned about the climate change crisis, and the government has responded in an attempt to combat the effects of greenhouse gases by implementing higher rates of taxation levied at the worst polluters, and handing more investment capital to cleaner methods of power generation. That is the current trend because when accounting for the lifetime generation cost of electricity, renewables are projected to be both cheaper and more efficient in the long run. This metric is called the levelized cost of electricity, and it has a steep drawback in that when this metric is paired with the external integration costs that would be necessary to utilize renewable energy in the same way that we currently use fossil fuels, the cost associated with switching from fossil fuels to renewable energy becomes much more expensive, substantially pushing out the point at which renewables become cheaper into the future. And that's before even considering the concerns regarding the potential for fossil fuel producers to accelerate their supply productions ahead of further regulation. Also unaccounted for is the very real possibility that the drop in fossil fuel demand could lead to such low pricing that countries who do not cooperate in climate policies choose to increase their fossil fuel consumption in order to achieve greater production. This graph, published as part of an article written by Foster et al. For the Journal of Energy Policy, illustrates the time it would take for renewables to achieve cost competitiveness with fossil fuels. And while we're just focused on the graph, the whole article is a worthwhile read if you're someone that's interested in a critical discussion of the obstacles facing the shift to renewable energy. Anyway, focusing back in on the graph, if the fossil fuel industry does respond to increases in the supply of renewable energy by lowering the price of fossil fuels, then the cost competitiveness of renewables could take drastically longer than anticipated, while also failing to achieve the goal of reducing emissions. If something similar to the price response projection shown in the graph does play out, then I could foresee the potential of a future wherein the desire to switch to renewables begins to wane. After all, if people want to switch to renewable energy in order to protect the environment, but doing so has the unintended effect of creating more emissions in the short to medium term while also being more costly, then it wouldn't be unreasonable to assume that there could be a significant reversal of public opinion on the funding of green energy projects. Now, none of that is to say that this is a guaranteed outcome or anything like that. But it should shine a light on the challenges associated with trying to determine how different types of energy generation can be expected to perform, and why I wouldn't want to stake my forever money on an investment that hinges on the balance of public opinion. Instead, as I said before, I'm more partial to investing in specifically the transmission and distribution side of the sector, because regardless of how the energy is generated, it all needs to be transmitted and distributed through power lines. As luck would have it, there is a Canadian company that is almost entirely centered around the transmission and distribution of electricity, and that company is Hydro One. Hydro One trades on the Toronto Stock Exchange under the ticker symbol H, and in my opinion, it is very likely the publicly traded Canadian company that best qualifies as a buy and hold forever stock. Now, I do already have a 38-minute video dedicated to specifically covering Hydro One in detail, so I'm not going to go through everything here. But to sum up the operational aspects of the business, firstly, Hydro One transmits high voltage electricity from high voltage transformers to lower voltage transformers throughout Ontario. This portion of the business is the most monopolistic, since Hydro One transmits over 98% of all of the province's generated electricity. But this segment also has the lowest margins. Secondly, Hydro One distributes the electricity from the low voltage transformers directly to the energy consumers in Ontario. And this side of the business is much more lucrative, though several large population centers operate their own municipally run local distribution companies, which lowers Hydro One's distribution footprint. Still, Hydro One has distribution lines that service over 75% of Ontario's geographic area. And that about sums up Hydro One's business model. As I said before, when you have a company with such a strong competitive advantage that it virtually monopolizes a needs-based market, you can definitely expect to pay a premium. And you can also likely expect that over the long run, the company won't have market-beating growth. Noting that, Hydro One trades at a PE of about 21, but the price-to-earnings ratio alone doesn't tell us much. To figure out whether or not that's a reasonable price to pay, I'd need to first understand how much the business can reasonably be expected to grow, and how much capital could be expected to be returned to me over time. Once again summarizing from my Hydro One video, to get a general idea of how much I expected to earn on an investment into the company, I first conservatively adjusted the variables that I deemed impactful to the business before building out a projection model. In Hydro One's case, these variables included the expected electricity demand in Ontario, the expected population growth of Ontario, the expected electrical consumption from and adoption of electric vehicles, the expected cost of electricity, Hydro One's expected margins, and the expected rate of share dilution. Using this data led to model projections of compounding nominal returns in the ballpark of 5.3% to 6.9% over a 25-year period. Now, 6% annualized returns might not sound great, but considering the security offered on invested capital, I would gladly take that over a savings account, GIC, or bond all day, every day. For the purpose of full disclosure, I do own shares of Hydro One, and it makes up about 17% of my standard Canadian equity portfolio, making it my second largest holding in the account. This information should raise an important question. If I believe that Hydro One is the best Canadian buy and hold forever company that will continue to return money to me over the long run, why doesn't it make up a larger position in my portfolio? There are two answers to that question. The first reason is because I'm an investor who is actively researching and evaluating different companies. So, while I do like the idea of having some money stashed in an investment vehicle that is expected to compound at rates better than government notes, I also realize that I can still find much better rates of return on companies where I might only need to be certain about the next 10, 20, or 30 years. And because I'm actively searching for new securities to invest in, I don't have the goal of putting all or even most of my capital into a business that I can hold onto forever. Instead, my goal is to find the best opportunities to grow my money as quickly and safely as possible. Take for instance my top investment, the Morguard North American Residential Real Estate Investment Trust, ticker symbol MRG on the Toronto Stock Exchange. Morguard operates in the residential real estate industry, where they own and rent out apartment units, which is a largely competitive market with tons of different choices, instantly failing to live up to the one trait that I've spent most of the entire video up until this point trying to convince you is the most desirable in a business you plan to buy and hold forever. But because the REIT owns buildings located in urban centers and major suburban regions within Canada and the United States, I can still have a reasonable level of security stemming from the fact that these properties are diversely spread throughout the two countries and are located in bustling locations with high demand where there is expectations of population growth. Plus, renting out property is a business that's been around practically forever and can't be realistically expected to go away anytime soon. In addition to those defensive qualitative features of the business, Morguard also has several positive quantitative features that lead me to believe that it's heavily discounted by the market. Now, I talk about Morguard in great detail fairly regularly in my Wealth Simple portfolio series, where I invest $100 per month into Canadian securities. But for this video, I'm only going to be focusing on one metric to illustrate the greater point, and that metric is the tangible book value per share. What this metric does is it first takes all of the company's assets and then subtracts all of the company's liabilities and all of the company's goodwill and intangible assets. This step gives an idea of the net worth of the company's real assets before accounting for any profits or losses. That figure is then divided by the total shares outstanding, which gives us the total underlying net worth of each individual share. Doing this for the Morguard North American Residential REIT results in a tangible book value per share of $46.41, which, at the time of recording this, is roughly 3 times the cost of one Morguard share on the market. Doing the same thing with Hydro One results in a tangible book value per share of $17, which is less than half of the current share price. This alone should make it easier to understand why I wouldn't want to overcommit to a position that will likely only return a few percentage points of capital per year, when theoretically, if I had enough money, I could buy enough shares to take control of the Morguard North American Residential REIT, then sell off all of the assets, pay off the liabilities, and finally issue a special return of capital style dividend to receive a tax-sheltered overnight gain of over 250%. In addition to using this example to explain why I wouldn't put most of my money into a buy and hold forever stock, this demonstration also highlights a crucial flaw in the philosophy of a buy and hold forever strategy, especially if you're doing so under the idea that you're not going to be looking at these investments for a period of several years or longer, or if you're planning on setting up some sort of trust that cannot be touched. See, the potential for an all-cash buyout is always on the table for practically every company that there is, even a company like Hydro One. If that does happen to a company that you've bought and held with the idea of doing research once and then leaving it to grow for decades, you'd probably be in for a pretty rude awakening 30 or so years down the line if you decided to check in, only to realize that you're left with a pile of cash that's been getting whittled away at by inflation over the years. The moral here is that using a buy and hold forever strategy should not come along with the misconception that it will allow you to be lazy. Even with this strategy, you should probably be checking in on your investments at least once per year, and that goes for you index investors too. If you invest in an ETF with the expectation that you can buy it and forget it, you need to be aware that any of these funds can be subject to liquidation at the behest of the company offering the ETF, and this is something that happens to many ETFs on a fairly regular basis. Now, to be fair, this generally tends to happen with ETFs that don't turn a profit for the company offering the fund, and that means that liquidated funds trend towards the smaller, more niche end of the spectrum. That said, if something negatively impacts one of the major fund operators, we could end up seeing some very large funds get liquidated. Also, it wouldn't be impossible for some of the larger, more popular indexes of today to end up being replaced with a newer standard, say 20 or so years down the line. Now, I'm certainly not predicting anything like BlackRock going under or the S&P 500 being replaced. I don't think that either of those are very likely to happen. That said, unlikely occurrences do happen, and it's good practice to take an hour or two out of your year to make sure that your forever investments haven't been swapped with an unproductive pile of cash. Personally, even as an aspiring investor, I like knowing that I have a chunk of my capital stashed away in an equity that can be expected to continue earning good returns practically forever. For anyone else who might find themselves similarly inclined towards finding an investment that will stand the test of time, I made this video to give you insight into my opinions, strategies, and knowledge on the subject in the hope that you'll find at least something of value that will help you progress as an investor. That said, I implore you to be aware that neither this nor any of my other videos should be used as a substitute for doing your own research. Instead, my content should be treated as a jumping off point for you to find out more about the businesses that interest you. This video is not financial advice, and it does not have the information required to make good investment decisions on individual securities. I am not a financial advisor, I'm just a Canadian who likes to invest and share my opinions with others. Thank you for watching all the way to the end, and enjoy the rest of your day.